Hey everybody, welcome to Market Mavericks. I'm Gareth Soloway, joined by Scott Melker and Mike McGlone. We are here to give you guys the Market Maverick basis of everything that's going on. I'm excited to talk to these two gentlemen to see what's going on. So first off, how are you guys doing? Everyone's doing all right?
Great.
All good.
Awesome, man. All right, so let's get right into it. We're going to keep it to a crisp 30 minutes, so let's get right into the hardcore stuff. First thing, I know Gary Gensler testified yesterday, right, Scott? Can you give us a rundown, like a quick, 30-second, I should say, rundown of, what was the takeaways from that?
The takeaway is that there's a few Congress people who have learned that they can get great sound bites out of attacking Gary Gensler, but none of it's going to move the needle at all. We could sit here and talk about all the amazing bad takes and things that people said and the criticisms, but the reality is that Gary Gensler is going to do exactly what he's going to do. It's his mandate. He's not changing course regardless of the, words of a small minority in Congress. I wish that he would, but clearly, he shows up, he takes his beating, and he goes back to work. And you may have noticed that 4 of them sent him a letter that said, you must approve a spot ETF immediately. 45 minutes later, he rejected the ARK 21 shares ETF a month and a half before he had to. So that says everything you need to know.
You got to admire his guts, right? He's just he's in your face, slam down, right? I mean, that's impressive. At least he's not shy about it. That's for sure. He's not scared of them. Now, one quick question, one follow-up there. We have some presidential candidates that potentially are crypto fans. Do you actually believe them, or is it just to garner votes?
It actually depends on the candidate. I think that Trump and Biden clearly are dismissive as anti-Bitcoin. I think that's more of a generational thing than it is a partisan thing, right? I think the older ones hate it and the younger ones like it. RFK genuinely is passionate about Bitcoin. I think Vivek Ramaswamy is starting to get there. Ron DeSantis is using it as a talking point, doesn't care at all, in my humble opinion. And then you have lesser candidates who aren't really talking about it that probably are relevant anyways. But the bottom line is, I think in a year, especially if prices start to go up, I think that we will have presidents who will be talking more and more about Bitcoin. That can only be a good thing either way.
Yeah, true enough. And I just wanted to throw up the chart here real quick of Bitcoin before we move on. Bitcoin, to me, on a technical basis, potentially is getting a short-term breakout here. I want to see where it closes today. But again, there's a down-sloping trend line from going back to the highs. This was the Ripple News highs here, which reversed. It kind of was the beginning of the fall. We can see clearly we attacked it over here in August. And then back over here, we attacked it 3 days in a row. In fact, this might have even been when we were just doing the show last week. 1, 2, 3, 4. In fact, we've got pushed back. Now we are above it. And so, again, the thought process of resistance lines for those of you out there is that the more you hammer on them, the weaker they become. And this is hammered quite a bit now. So it makes sense. Maybe we have a short-term little up move here. And then the question is, how high does it go? I have a max upside of around 30K in the near term, and that would just be a momentum move. But pretty interesting to just kind of watch this candle today. Does it open the door, at least for a short-term move, for those of us that are more traders? Now, Mike, a couple things I want to talk about here, right? So when we look at what's going on, there's some massive stuff on the global scale. We have the dollar yen obviously issue. We have oil going on. We have yields which have surged, I think hitting 4.65% today. And the dollar has been a monster, right? And we've seen the stock market begin to crumble. You've talked a lot about is this the beginning of kind of that scenario that you've been referring to that is starting now to be the detraction, the downfall of what we've been seeing, the reset, I think you referred to it as?
Yeah, unfortunately, yes. If I can share my screen, it's all tilting that way. And I'm going to start with just piggyback on your Bitcoin chart, because to me, Bitcoin is the #1 leading indicator on the planet for what's happening. And the key thing to remember about Bitcoin is it's about liquidity and beta, and both are negative right now. Particularly if I'm right and the stock market enters a recession, a typical decline for recession, that's going to drag down this this 50 vol asset. Eventually it'll come out, but it's also liquidity. That's what I show you in this white chart. That's Fed fund futures in 1 year. And if you see virtually every time Bitcoin's had a good bottom, the Fed fund futures, this is right here, it would turn back up, means liquidity is coming back on, but after markets go down, turn back up again 2000, after markets go down. What does it take to turn liquidity on? Markets have to go down. To me, that's what we're facing right now in terms of the big picture in the macro now. So let's talk about 10-year note. What's the 10-year note yield doing right now? This is a collapse in prices. So I'm just showing you a 20-year chart of 10-year note yields. This is this is a percentage change, but it's up the highest level since 2007. And see how rapidly it's spiking. You know, that is very akin to right before the stock market crash in '87. That was the key thing. Remember, I come from a treasury bond market. This is what the stock market, the treasury yields 10-year note was doing. It was in a really bear market, went up about 40% in terms of yield that year from like 7 to 10. It spiked, it peaked the day before the crash. Bond market was collapsing. And that to me is one of the parallels I'm learning, I'm worried about. And then you look at let's go to a little bit over to crude oil. I love the analogies people use in crude oil, but crude oil has similarities with what it did in 2008. It peaked in 2008. When it rallied to that high, I still have never gotten a really good solid reason why it went up, because that's why it collapsed. And getting that a little bit more now, the key thing I want to show you in crude oil is what I show you on this chart is lower highs and lower lows, but in white. This is just going to take a second to maximize. I'll show you in a second when I bring it over. Once it gets big, this is inventories. Now you've heard this hit the popular press. It's inventories in Cushing, Oklahoma. So just to give a little bit of crude oil geek stuff, that's where the delivery point for futures is. It's basically become insignificant because of what's happened in the U.S. I show you, here's a chart in a bigger screen. In the U.S., every time this inventory level in Cushing relative to total inventories has got to levels we are now, market's peaked. Why? Number one, markets peak when inventories are low. That's a fact. People just forget it. Also, Cushing doesn't matter anymore because we export it matters, but not as much. We export so much that what oil's avoiding Cushing, going straight to the Gulf to get out. So another thing I want to point out is when people say, the thing about crude oil is it's not rallying with confirmation from everything else. It's industrial metals are going down. Agriculture is going down, copper is going down. That's not endorsement of crude oil. That shows it's going to be a temporary move. Now, yes, I didn't pick the peak, didn't pick the bottom, but it still looks to me like it's a bear market that's going to be rolling over. So just a few other charts I'm going to show you real quick. This is the liquidity thing from crude oil is negative. Manage money net positions. This is one thing I'm waiting for someday we can show in cryptos, where you can show, I'll bring it over in a second, when you can show what the net positions are. They are the longest. This is hedge funds, the longest since the peak, like around last November, right around around $94 a barrel. So the signs for crude are like up on the escalator, down on the elevator. And one thing I want to show, the final chart is, I'm not going to maximize this because it's a lot of data. See that white line? That's the number one thing to remember in crude oil. That is the total amount of US and Canada production minus consumption. It's a wave of negativity for prices. Prices peaked here when we were importing US and Canada 11 million barrels a day. Now we got a problem. We got to export 6 million barrels a day. So that's how the world's changed. And just one thing I'll end with. My colleague just drove his Tesla to the office. This is unleaded gas demand declining, yet miles are going up. So that's the facts of crude oil. But in the macro big picture, to me, this is just a chart I showed a little bit last week. I can bring back in a little bit, but just a sign of the stock market is the most expensive versus GDP in 90 years. And we're coming off the zero interest rate policy. To me, this is what's going to really kick in. One other thing, I went to see another Bloomberg customer today, 73, very wealthy, retired person, and he was salivating over all the bonds he can buy and getting great returns, and said, I'm not going to touch the stock market when I can get 6-7% in these very low risk bonds.
Interesting. That's really interesting. And one thing I would just point out, folks, is that think about where oil is in the cycle. Think about where people's sentiment is in the cycle, right? So you have this sentiment where people are saying probably no recession, economy's going to be great. Well, obviously that's going to mean demand, or perceived demand, is going to be strongest. It's going to drive oil up potentially. I also think there's a huge kind of under investment in crude oil stocks, and we've seen so many funds moving into those, which then just artificially lifts these things up to kind of ridiculous levels. And last thing I'll show here is, I tweeted this out earlier, but the point is, there was this tweet at me. This was overnight, right? I'm out of the short of oil, big loss. Oil hit 95 tonight, blew through chart, could hit 100 by Friday. That's emotion, guys. You have to recognize this as emotion. And when emotion hits, it's usually, and again, this is when, by the way, overnight crude oil, if we flip over here, it went to 95, but it was an overnight move. It was right here. Basically, oil was 93, boom, and then it was done. And that was enough to push people out of the market, which again, it gets the stops. It hits the stops. This gentleman, same thing. And it reversed right after that. And that is such a common thing in the markets, to push people to the maximum. The way you don't allow that to happen is you moderate your position size. And I think we were talking about this, Mike, Scott, and I were talking about this prior, is that that's not someone who kind of went with a normal allocation in oil right there. That's someone who leveraged themselves and then couldn't take the little bit of a pop. And the market feeds on that. Like it's literally like shark infested waters. They're waiting for you guys out there to over leverage so they can just push it in one direction, make you think you're going to get crushed, and boom. And then it reverses and goes in the way you kind of wanted. And Scott, I'm sure you've had that experience. Mike, we've all had that experience.
Yeah. You never want to be the liquidity that someone's engineering, but we all have been, and that's why stops get swept. Can you bring up my chart for 1 second? I just want to talk about something to give a bit of a counter view. I am generally bearish like you guys are long term, but it's very important to speak on time frame, because I would say if you saw what happened in the market yesterday, there was very good reason to be bullish today and potentially moving into next week if you're trading on shorter time frames. For anyone who uses Tom DeMark TD, we had a TD sell 9 on yields. We had a TD buy 9 with a hammer candle with a long wick down to the bottom on the SPY and on QQQ as well. And now we're getting bullish engulfing candles. So I think we have a good case right now for at least a short-term bounce, right? That doesn't mean that next year we're not going to be in the Great Depression. I have no idea. But I would say that if you are looking to trade this on a daily or lower than intraday time frame, you have some actual cause to be bullish right now. And that was clear with Bitcoin as well. Gareth showed the chart with Bitcoin with the descending resistance. Take a look at the 50 MA on the daily. 1, 2, 3, 4, 5. This is the 6th time it's attempted a move at the 50 MA this month. Let's see if it can actually close above that on the daily. I think that would be quite bullish and gives us cause to believe we could get up to 28, that 200 MA. Again, talking short term. And for those of you who like the line chart, which eliminates some of the noise, we have a potential breakout there following a breakout on the same pattern and retest on RSI. So just to give you the quick hits, I think there's cause to be potentially bullish over the next week, 2 weeks, 3 weeks. But that doesn't change anything about what Mike is saying about the macro and what could likely be coming in the future.
Yeah, and 100% agree on that, Scott. And I'm right there. And I know people look at us and they're like, "Oh, the Bears." That's a bigger time frame. And the beauty of what we do, right, is that we can look and say, okay, markets are showing us bullish signals right now. So now's the time to get a little bit of bullishness. And that doesn't mean in a week it might not switch. We'll let the charts dictate us how to do it. But one of the things I want to show, and I think I showed this last week, is this trend line, right? This is a weekly chart of the 10-year. And look at the trend line. And again, all I do is I let charts speak to me, right? So what I can clearly see is that we hit the line here, we hit the line here. Every time we did, we bounced. Then we broke below it. And then when we went back to that line, we pulled back to the line, pulled back to the line, pulled back to the line, pulled back. And so all I did was I said, oh, wow, well, what's the probability that if we get back to this line, we could have a pullback again? And so it's a probability game. And if we go to the daily chart of the 10-year, and again, this is the beauty of it right here, that is what's called a topping tail. And topping tails in technical analysis signal a reversal in trend. And the last thing, just to tie it all together, is that we know that when yields go up, markets sell. We know when the dollar goes up, markets have been selling. And today, interestingly enough, the dollar is reversing very close to a similar trend line. But what that means is short term, if we have a pullback, and this is, again, Scott and I are just referring to like the next week or so. But if we do get a pullback on the dollar, if the yields pull back, and by the way, PCE data tomorrow is coming out, the favorite inflation gauge of the Fed, then it does make sense we could get a short-term bounce in the markets. And even with crude oil coming in, that might help alleviate some worries about inflation as well, right, Mike?
Well, that's the key thing, what it's done in the past. To give you facts of 2008 when it peaked, the high that year for PPI was plus 9.9%. The low this year for PPI is minus 3.1%. That's deflation. Yes, it's bounced, but it's going that way. If I can tilt over my screen, what I show you there is this is just one of the most enduring things that's indicators. All leading indicators are showing recession. We haven't had it yet. Yes, we've been early, but every single time, that's why I show you in white, is we have a recession. So tilting over to me, the big picture, just you take the S&P and you overlay it with the U.S. GDP, times 100 in trillions, and you get, it's the most overvalued ever. So, but to me, this is the macro where we're going. But the thing about crude oil is, let's just pull up what's really mattering right now. Is the bottom line, I showed this last week, is the Fed this is a WIRP function at terminal. It's showing right now the market's still expecting, we've dropped a little bit, expecting rates to still rise up to 5.43%. It's still pricing in hikes. And the number one, and I've mentioned this a lot, but the first baby step for markets is to take this tightening out of the market, or to tighten. And there's only one really way, I think, to do it. It's the market to go down. I showed you that with cryptos, but it's usually the stock market. But it's the key thing about, let's look at crude oil real quick. The thing I want to show you about crude oil is it's an enduring bear market that's bounced. And I love to point this out particularly with people who are bullish crude oil, because it's just doesn't go up compared to let's just go back to 2007, compared to like broad commodities. So this is just crude oil. It's going to pop up in a second. Since 2000, okay, you had that big negative period. Lower lows and lower highs. So let's look at overall commodities. How about copper? Let's just go to copper. Copper is the industrial metal that's actually down this year, down about 10%. Typically, they should flow together. There we go. Higher highs, higher lows. That's a bull market. It's coming back still. So that's one thing I like to point out, the difference. And the thing that's really happening this year from an inside commodities group, guys, when crude oil goes up and copper goes down, that's really bad. That means crude oil is just spiking for a short-term thing. It's going to probably drag the global economy with it down like it did in 2007. And copper's going down because it's reflecting this negativity in the global economy. And it's everywhere. It's actually a recession in Europe. They're still tightening. Property crisis in China, which is probably as bad as Japan was 30 years ago, and we were 15 years ago. And the U.S. recession tilt, which I showed you otherwise. The key question I always ask myself is, what changes that?
So I think for those of you guys that are listening in, I think we all agree with Mike on the longer term here. And I think the idea is that short term you can have bounces, but it's very clear to me per the S&P chart. And I'll flip over to the S&P. I got gold up here, but the SPX chart is clearly making lower lows now and lower highs, right? If we just zoom in right here, high, low, lower high, lower high, lower low. And so the trend has changed, which means that over the bigger picture, that means we're probably headed lower the next 6 months, 12 months, etc. But short term, we have reversal signals. And one of the things that usually happens in markets is that oftentimes you have a rally back to your trend line where you broke, right? So very clear from the October low here right up. My guess is that's where we're trading back to, maybe 44.50, 44.25 on the S&P. And then the next leg starts to the downside, which would continue, by the way, lower lows and lower highs on the chart. Scott, in terms of the markets, like, is this a time like Bitcoin? All right, Bitcoin, maybe play a little Bitcoin to the long side. Do you still stay away from altcoins, or do you think do you have any views on the altcoins out there?
There have been some that have popping off, but it's really hard to identify what's good. And usually you're too late by the time you see any sort of trend. So I don't really have that much that's worth pulling up. I mean, I have a few that I'm just kind of constantly watching. Matic, nothing doing, maybe at support. Injective kind of looks decent. BNB right at the bottom of the range. Most importantly, I think is you have to look at ETH BTC, right? We've basically been in a downtrend, Ethereum against Bitcoin, for well over a year now. You're looking at August 22, September 22 at topping here and coming down. But now, to me, it's at a key level of support, and Ethereum actually looking like it could have a bounce here. This could be one of those moments if Bitcoin stabilizes at 25K that altcoins perform, but you have to time it perfectly. And for the average person, it's just not worth trying. This is a risk-off environment, I think, for altcoins in general. Yes, you may miss a move here and there, but 99% of these coins have been moving down or having slight moves and then retracing them all the way back. So it just does not excite me in general. Just to speak to what you guys were talking about before, I see people in the comments. I still think that we have a massive Bitcoin bull market end of 2024 and through 2025. I'm a slave to the 4-year cycle until proven otherwise, although I think that it could obviously change this time. And Bitcoin is not moving at all right now with other markets. That could be strictly because there's little volume volatility and there's apathy. But either way, you can have dollar going either way. Bitcoin does nothing. Stocks going either way. Bitcoin does nothing. Gold dumping. Bitcoin does nothing. So it's hard to make the argument that it's correlated to much at the moment. This looks just like every third year, end of the third year in the cycle.
Scott, I was just going to Oh,
I can
sorry, Mike.
Let me just piggyback on that really quick. I think Scott Martin brought out something that's very profound in history of markets. Is one of those lessons is you never short a dull market.
No market. Yes.
And that's one thing I want to point out about Bitcoin. And I'm waiting for Bitcoin to give me signals that it's showing divergent strength. And I'm showing you something here I'm still concerned about. Is you talked about alts. So I like the Bloomberg Galaxy Crypto Index. Obviously, I show you that in white. It's still well below that peak from 2017. What I overlaid it here with is a Russell 2000 small cap index. A lot of similarities because they both really thrive on liquidity. For small caps, it's not really profits, it's like liquidity. And both right now, bottom line I have to point out is make to reiterate, is liquidity is negative, and if the Russell continues to break down, this is a 100-week moving average, it's showing downward like it does for a normal recession, it's probably going to take most of the alts with it. The question is how to Bitcoin respond. So I don't disagree with Scott. In 24 we're going to get a breakout, but it might might be from a much lower level. We got to get through this period of recession, and the point is we still have a liquidity rug pull in the market. But I want to also tilt back to what you said about gold. This is a nice long-term simplistic chart of gold that I think is, I so enjoy doing this simple one. If you take the per ounce price of gold and overlay it with the S&P 500, they've basically been playing cat and mouse since the U.S. came off the gold standard in 1971. And when gold's expensive versus the stock market, you get a recession, which is what we have in red. Gold underperforms, the stock market takes off. The last two times we had recession, gold was historically very cheap. It was just below the price in terms of ounces of the S&P 500, and gold took off. But right here, it was low. But now the point is gold's about half the price of the S&P 500. We're heading towards recession. So my point is they diverge at 3,000. It's that simplistic outlook. Let's see how much that gets knocked around and beat up. But I think they meet at 3,000.
Two questions, one for each of you guys that I've heard people ask me, one that I'm curious about. So first one, Scott, what we've seen in the cycles, at least recently, right? We saw Bitcoin top out in, I think it was early November. The stock market topped out in, I think, December or January. And then we saw the highs here in Bitcoin kind of come in, right? And I'll show my chart real quick, but we topped out on Bitcoin recently around July. And obviously the stock market topped out. If we go to the SPX, it looks like the high was late July, right? So it was a little bit after. So is that something that traders should be aware of? Is that, does it seem like, is there a history of Bitcoin kind of topping before and being a leading indicator for the asset markets like the stock market?
Mike would tell you yes. I would tell you I'm not sure. If you had asked me 2 years ago, I would have said that Bitcoin's way too small to be considered a leading indicator. If anything, it's its own market, it's nascent, whatever. But now, I mean, there is some data. You can look at least anecdotally and see that it's making moves largely before other markets. You can go back to March of 2020, of course, the COVID drop, everybody knows. Black Thursday, Bitcoin went below $4,000. The stock market bottomed 12 days later. Right. So Bitcoin did lead the stock market down, showed you that major sort of bottom was forming. So it certainly can happen. I'm just not really worried about Bitcoin above 25,000 right now. I think that's sort of a make or break line. But like if you were to ask me what's going to happen in the next year, I would say, I don't know, range from 20 to 31 and then eventually break out. Right. We'll probably see like 19.5. We'll probably see 31. We might see 35. I don't expect to see 70.
Gotcha.
So
and then,
just following up on that, Gareth, I think this is where it's a great test for Bitcoin. I'd love to show leading indicators of divergent strength, of it going up and the stock market going down. I'd love to see that. I don't think that's going to be a while. And or to show the leading indicator of it, stock market following it up or all going down together. And this is what I show you here. I did this a little while ago. I pointed out its leading indicator status, and you can see in the chart. The 20-week moving average in Bitcoin's rolled over downwards. It did it earlier on, back in at the end of beginning of 2022, it rolled all over well before the S&P 500. I think it's doing it again. It's already started rolling over. And the bottom line is what I show you in this chart here. It's liquidity is what matters for both. It's the key thing, as Scott has heard me say for too long, is market's still fighting the Fed. The problem is we're still saying it, and the recession leanings are getting worse. So to me, this is the thing I look for all the time. Is even Bitcoin started heading the way up earlier when we bounced for that little bounce, and that was just kind of I think more short covering bounce, but. It's the liquidity thing that I think leans me to say Bitcoin's picking it up on this first. The stock market hasn't rolled over yet. It's starting. This is a 20-week average, and it's just a question of when.
So kicking it back to gold real quick, and this is a question I had for you, Mike, is that, historically we've seen gold sometimes go down when the stock market goes down. And that's one of the most common, I've been a bull on gold. Honestly, recently gold's been hammered, dollar's been strong, but today gold's down and the dollar's also pulling back. It's kind of right into major support here. But what do you tell people that keep asking, if the markets really get crushed, won't gold go down too? I mean, what do you say to that?
Yeah, initially, I can show it on the chart. Initially, that will happen if history is a guide. First of all, remember, gold's made new highs in most other currencies, most notably yen and the yuan. Gold's doing what it's supposed to do in terms of currency debasement. But I show you here as a chart I remember well because I felt it. I wrote it. I was long a lot of gold, a lot of treasuries, zero coupons before the big collapse in 2007-8. Yes, that one I got right, but I was early. But gold was bumping up around 1,000, and then it dropped to 700, and then it broke off to 1,900. I expect similar. I think that's what it's doing now. But what has been the gold pressure thing right now for all risk assets? Scott sees, I say this all the time, it's that 2-year note yield, 5.07 at the moment. It's a giant suck and sound, and that strong dollar for dollar price gold. But at some point, when we get that tilt for normal recession, as I pointed out earlier, gold almost typically outperforms, particularly when it's relatively cheap versus a stock market that's relatively expensive on a historical basis.
Gotcha. Going into tomorrow, PCE data, right? Markets are going to react. Do you guys have any? I mean, listen, no one knows the future. I totally understand that. Do you guys think that I mean, and again, this comes to prediction, but also charting, topping tail on the 10-year. Do people know something about that PCE data tomorrow that's maybe telling you yields are going to drop and it's going to be a better than expected lower inflation number?
Scott? I think you're.
Sorry, I was muted. I said I'd give that one to Mike. That's
yeah,
all. That's
you're throwing it over.
You.
So I'm just showing what to expect tomorrow on the screen from PC, the deflator year over year. It's core that matters. Markets looking for the bottom line is the year over year is at PC core is at 4% basically. Okay. That's double what the Fed expects. So the way I can remember, think what's happening in the bond market right now, I think it's similar to the stage it was right before the stock market crashes 87. I'm not saying it's predicting a crash 87, but the bond market is crashing right now. Yields are going up way faster than most people expect. But what you saw today is that massive volatility. Yields spiked this morning and they're back down. That's typical end of the quarter stuff. It's also what you expect. And the bottom line about this number is what our economist tells you. It's still double what the Fed wants. So we might get a favorable number. And then, okay, it's going to keep the Fed sticky. But the key thing I need to point people to look forward to in the future, the iterations expect to, this number, these inflation numbers will follow PPI, in my view, and go negative in a typical recession, maybe even a severe one, depression. That's just what happens. Inflation deflates. Deflator. But the point is, you don't get to deflation without disinflation first. And we've started that process. The point is, we're severely disinflating, and the Fed, most central banks are still tightening, and China's tilting over into recession. So see that tilt there? They're still tightening, that we're getting that severe disinflation. The next stage to me is the deflation.
All right, interesting. So for me, at least, when I'm looking at that reversal today, yields remain extended even with the reversal today. I would be on the side where even, who knows where we are, like we said, in a month from now, but I would be in favor of maybe yields coming in tomorrow, the dollar continuing to sell off tomorrow. Both have had tremendous runs. So short term, again, that's the angle. And just to put my money where my mouth is, my biggest position in my portfolio right now is the GLD. So based on that, I've been kind of accumulating the last couple of days on this dump out. Second biggest position, WBA, which is, again, a stock. And again, not a recommendation to buy, but I'm just kind of giving you guys some reality of what I'm playing here. But yeah, I mean, gold, definitely. I have a TLT position where if yields pull back, that'll do well as well. So for me, that's my short term. Long term, again, past a few days, that means nothing. What I have now, I'll tell you guys right now, my average hold time for a stock is probably 24 hours. Some are a week, some are 5 minutes, right? So it's obviously can change on a day-to-day basis based on the charts. Lastly, let me just say here, guys, amazing show today, by the way. I love the quick pace, the data just boom right in people's faces. I think everyone appreciates that, getting the most out of 30 minutes. Scott, what else should we be talking about here? I mean, is there anything else that you want to kind of get in here?
Well, the only last thing I would say is that seasonality generally plays. If anyone's surprised that we ended up down in September, then they haven't looked at their history, right? And you're talking about coming into PCE tomorrow. This is gold, of course, which has been dumping. I also think if yields are topping probably a good time to get into this short term. But listen, if you believed we were going to do well in September, the odds were strongly against you. But I can tell you that crypto generally has, maybe not in this year of the cycle, but generally does quite well in October. October, I think, is not just a meme. I think it's 20% up in 7 of the last 9 years in Bitcoin's history in October, and 35% up over the fourth quarter average over the last 9 years. So maybe this time is different, or maybe now is that time that we do get that sort of push to the top of the range and things outperform, and you actually can have some fun with altcoins for a little while.
Amazing, man. And then, Mike, what else should people know going into the next, let's say, from now until the next Market Mavericks? And I see Minnesota saying, wish the show was longer. I love hearing that. We're going to keep on coming back every Thursday, give you guys all our updates, but we're going to keep it crisp so no one gets bored of us and no one gets sick of seeing our faces. But, Mike, tell us, what should they know before next show?
Oh, that's a good question. I look at it as, I think the bond market's key. I think by the next show, if we still continue to see weakness in the equity market, I think that's tilting towards my outlook for the great reset kicking in. And the chart I showed you earlier, you can kick on it now if I want, is what's happening is we're having a collapsing bond market. I mean, that means that everything's going bad, but it also means a giant sucking sound for risk assets. And bond yields and stocks and risk assets typically go down in recessions. Our outlook by the end of the year is the recession, U.S. recession starts, and most people who trade money now have not experienced a recession, which has been really about 14, 15 years ago. We're way overdue for a real big one. And the difference this time is the Fed's not going to be there to save you. They've already warned us.
Amazing. And then I will say this is that for me, one of the thoughts that has crossed my mind over the last couple days with yields soaring like this is how many banks are borderline in major trouble. And I wouldn't be surprised if we hear over the next week that something did occur, because when rates jump or anything jumps this quickly, things tend to break. Now, the question is, does the Fed kind of try to cover it up so it doesn't freak the markets out? I don't know if they can, but it certainly, to me, would not be surprising to hear something has gone amiss in the system with rates spiking this much. And by the way, it's one of the reasons why I think rates can't go up that much more, because you will start to see a financial crisis.
Well, just wait for the United States government to have to refinance a third of their debt at 8% instead of the sub 2% that they currently have it at, because that's coming also in the next few months.
Brutal. All right, guys. Amazing show. Guys, Scott, I know you're on Twitter and YouTube. Anywhere else people can come find you?
Just find me at Scott Melker on Twitter. You'll find everything else from there.
And what about you, Mike?
Twitter, LinkedIn, and Bloomberg Terminal.
Wonderful. What about you, Gareth?
Same spots. We hang out at the same spots. What can we say? Just come back. I just ask everyone to come back next week to Market Mavericks. I love seeing views are up today for the live. That means a lot to us, guys. Really appreciate it. Spread the word, retweet, reshare, tell your friends, and we're going to keep on bringing the best info for you guys. So have a wonderful rest of the day. Thank you, gentlemen, for joining today, and we'll talk to you soon.